Because in today's world, understanding the system is more important than just earning money. Subscribe to Capital Explained, Saturday, February 28th, 2026. Exactly 24 hours from now, Asian markets will reopen, Sunday night, 6 p.m. Eastern Time. And according to energy analysts speaking to global financial media, oil prices could jump sharply the moment trading begins again. Estimates suggest a possible rise of $10 to $20 per barrel within a single trading session. That means oil, which closed near recent levels on Friday, could suddenly move toward the $80–$90 range, or even higher if panic buying begins. And oil is only the beginning. Market watchers across major financial networks are already warning about turbulence. Investors are preparing for what markets call risk-off sentiment. Risk-off simply means investors selling stocks and moving money into safer assets like gold, cash, and the US dollar. Gold is already trading near record highs after a strong rally this year. While many stock portfolios struggled to grow, safe haven assets quietly moved higher because large institutional investors positioned themselves early, long before retail investors noticed the danger. So when Asian markets open, and when retirement accounts update on Monday morning, many people may suddenly realize something important. Geopolitical conflict does not stay on the battlefield. It travels directly into personal finances, because war often destroys wealth for unprepared investors while creating opportunity for those positioned in advance. Now understand what happened during the last 24 hours. On Friday, even before major escalation, markets were already reacting to fear. Major US indices closed lower as investors anticipated conflict rather than confirmed outcomes. History shows markets usually react twice during geopolitical shocks. First to expectation, and second to reality. And reality reactions are usually stronger. When uncertainty rises, markets follow a predictable pattern. Investors sell first and analyze later. Selling creates momentum. Momentum attracts automated trading systems. Those systems accelerate declines, creating a cascading effect across global markets. The only unknown factor is magnitude. Will markets fall 2%, 3%, maybe more? Global markets in the Gulf region open hours before US markets. These exchanges often act as an early signal. If regional markets decline sharply, US futures typically adjust downward before American investors even wake up. This creates something called a gap down opening, when markets open significantly lower than the previous close without giving investors a chance to react. Your portfolio value on Friday might be one number. Monday morning, it could instantly open several percent lower. No warning, no opportunity to sell beforehand. Because institutional investors trade across time zones, Asia, Europe, and overnight futures markets, while most retail investors remain inactive. This timing difference creates a structural disadvantage. Now consider what a small percentage move actually means. If a retirement portfolio worth $130,000 declines by just 3%, nearly $4,000 disappears between market sessions, not during trading hours, but overnight. And that is only the market reaction. Energy prices create the second wave. Historically, every $10 increase in oil prices pushes gasoline prices noticeably higher within days. If oil rises sharply, fuel costs increase, transportation becomes expensive, and businesses pass those costs to consumers. Higher diesel prices raise shipping expenses. Shipping costs raise grocery prices. Higher prices reduce consumer spending power. This process moves quickly, often faster than wages or policy responses can adjust. And once inflation pressure rises again, interest rates expectations change. When interest rate expectations rise, bond prices fall. When bonds fall, banking balance sheets weaken. When banks become cautious, lending slows. Less lending means businesses invest less. Investment slows hiring. Slower hiring weakens economic growth. That economic slowdown eventually shows up in corporate profits, and declining profit expectations push stock markets lower. Everything becomes connected. An oil shock leads to inflation. Inflation pressures interest rates. Interest rates stress banks. Bank stress tightens credit. Credit tightening slows the economy, and slower growth reduces market valuations. This chain reaction is known as a financial transmission mechanism, where an event thousands of kilometers away gradually affects household finances. During periods like this, diversification also behaves differently. Normally, portfolios are balanced so different assets move independently, but during systemic stress, correlations increase. Stocks fall together, international markets decline together, even bonds may drop if inflation fears rise. Assets that were supposed to protect portfolios sometimes move in the same direction at the same time. That surprise is often what shocks investors most. Monday morning, therefore, is not necessarily the crisis itself. It is the moment of recognition that markets began adjusting earlier. While most people were offline, sleeping, or unaware of developments unfolding globally, financial markets operate continuously somewhere in the world. Information moves instantly, but reactions happen unevenly. Large institutions act first because they monitor risk constantly across global exchanges. Retail investors usually react after prices already reflect new information. This timing gap explains why many investors feel trapped during sudden market moves, selling locks and losses while holding exposees' portfolios to continued volatility. Meanwhile, rising energy costs begin affecting daily expenses within weeks. Fuel, logistics, food prices, and household budgets. If conflict continues, markets gradually price a new reality. One with higher geopolitical risk, elevated energy prices, persistent inflation pressure, and slower economic momentum. Markets eventually stabilize, but often at lower valuation levels than before uncertainty began. So Monday is not the end of the adjustment. It may simply be the first update. Each trading day brings new information. New information changes expectations, and expectations change prices, until markets fully absorb the new global situation. That is how events occurring thousands of kilometers away can quietly influence savings accounts, investment portfolios, and everyday living costs. Not instantly, but through a chain reaction that begins the moment global markets reopen. Welcome to the interconnected global economy, a system where almost everything influences everything else. And in many situations, ordinary people absorb the costs while others capture the gains. This system operates exactly as it was built to operate. Wealth often moves from the many to the few, from the unprepared to the prepared, from reactive investors to proactive ones. And tomorrow is when that transfer becomes visible. Tomorrow, your financial apps update. Tomorrow, numbers change. Tomorrow, reality becomes measurable. You may realize that a conflict happening nearly 9,000 miles away has quietly reduced your financial position. Not through direct destruction, but through financial markets that link global events to personal money. Geopolitics becomes personal finance. Events in distant regions begin influencing retirement funds, fuel prices, savings accounts, and daily expenses. The mechanisms connecting global conflict to household finances activate the moment markets reopen. Tomorrow, markets react. Tomorrow, account balances adjust. Tomorrow, many people begin paying economic costs for a war they never started. This is the reality of modern finance. Financial security tied to global events beyond individual control. Welcome to Monday morning. But the cost of conflict is not just a number on a screen. It appears as difficult financial decisions forced upon people within days. Imagine Monday morning. You check your retirement account and see it down nearly 3% after market declines. Do you sell investments to avoid further losses? Selling protects against additional downside but locks in the current loss. Holding investments allows recovery if markets stabilize, but risks deeper declines if tensions continue. You must decide without certainty. During active geopolitical crises, the future cannot be predicted accurately. Decisions are often driven by emotion rather than complete information. Fear encourages selling. Hope encourages holding. Most investors are forced to choose between imperfect options created by events they neither caused nor control. That is modern investing during global instability. Now move to Tuesday. Fuel prices at the pump begin adjusting. What was R's equivalent of $3.50 yesterday suddenly rises closer to $3.90 or higher. Within days, prices continue climbing as oil markets react to supply fears. Your weekly fuel expense increases immediately. Commuting cannot simply stop. Jobs still require attendance, and transportation costs follow market prices. There is no negotiation with fuel markets, only higher expenses that must be absorbed. But absorbing higher costs becomes difficult when investment balances have already declined and salaries remain unchanged. Wages typically adjust slowly, often yearly, while energy prices can rise within days. Income grows gradually, expenses jump instantly. This reduces real purchasing power. When essential expenses rise, households begin cutting discretionary spending, dining out, entertainment, shopping, or savings contributions. When millions of households reduce spending simultaneously, businesses experience declining sales. Lower sales reduce company profits. Lower profits pressure stock prices. And falling stock prices further impact retirement portfolios. This creates a compounding economic effect. An initial shock followed by secondary consequences that last much longer. The burden also affects income groups differently. Lower-income households spend a larger percentage of earnings on transportation and necessities. Even moderate fuel increases consume a meaningful portion of total income. Higher-income households feel pressure too, but usually have flexibility to reduce optional spending. Families already operating near essential spending limits often have only one remaining option: borrowing. Groceries, utilities, or emergency costs begin moving onto credit cards carrying high interest rates. Debt grows quickly when interest compounds, increasing financial pressure month after month. Oil shocks historically create this unequal impact. Those least able to absorb rising costs feel them most intensely, while investors positioned in energy, commodities, or safe haven assets may benefit. This pattern has appeared before. During past energy crises, geopolitical conflicts disrupted oil supply, triggering inflation, economic slowdowns, and market declines. Rising energy costs spread through the economy, eventually affecting employment, growth, and household stability. The sequence tends to repeat. Conflict creates uncertainty. Uncertainty raises energy prices. Energy prices fuel inflation, and inflation slows economic growth. Yet the financial consequences are usually carried by ordinary households managing daily expenses rather than those making geopolitical decisions. The impact is also psychological. Financial uncertainty increases stress. Stress affects decision-making, productivity, and overall well-being. Seeing investment losses or rising living costs creates anxiety about retirement, job stability, and future security. That anxiety can influence sleep, work performance, and family life. Hidden costs rarely discussed when markets become volatile. In a globalized economy, distant events no longer remain distant. International conflicts influence inflation expectations, investment markets, and even mental peace. Many people hope diversification or government action will fully protect them. Diversification helps under normal conditions, but during widespread crises, markets often move together. Recoveries usually take longer than declines. Markets can fall quickly but rebuild slowly, and if new shocks occur before recovery completes, progress resets again. Temporary declines become permanent losses when individuals are forced to sell investments during emergencies, medical bills, repairs, or unexpected expenses that cannot wait for market recovery. This is how global crises translate into long-term personal financial damage. Now imagine 1 month later. If tensions persist, oil stabilizes at higher levels. Fuel, groceries, and utilities remain elevated. Monthly household expenses rise while income remains unchanged. Over a year, even modest monthly increases accumulate into thousands in reduced purchasing power. If additional expenses are financed through debt, interest payments extend the financial impact long after markets stabilize or conflicts end. Temporary shocks can therefore create multi-year financial consequences. Debt accumulated during crisis periods does not disappear when headlines fade. Recovery in markets does not immediately repair household balance sheets. Savings growth slows. Investment contributions decline. Financial flexibility reduces, all tracing back to the moment markets first reacted. This illustrates how global financial systems transmit geopolitical shocks directly into everyday life, quietly but powerfully. War may occur far away, yet economic effects travel through oil prices, markets, credit systems, and inflation until they reach individual bank accounts. Tomorrow is simply the moment many people begin to see that connection clearly. Tomorrow, markets reopen. Tomorrow, prices adjust. Tomorrow, reality updates. Welcome to tomorrow. It begins in the next 24 hours.